Welcome to the Opening Bell Report.
Okay, stop what you are doing. We have to talk about the number 400, specifically $400.
Right.
Because if you've been watching the markets, you know that Microsoft, the giant, the titan, has officially smashed through the $400 barrier.
It is a massive psychological moment. It just feels different than $399, doesn't it?
It feels huge. I mean, we were talking about a close at $401.14. And even in the after hours, it was pushing up to $403.
Uh-huh.
So naturally, the question on everyone's mind, and certainly on mine, is simply, is this real?
That is the billion-dollar question, or in Microsoft's case, the $3 trillion question.
Right. Is this just a blip? Is this what they call a dead cat bounce?
Yeah.
You know, a temporary recovery that just falls flat again?
Or is this the start?
Or are we witnessing the ignition sequence for a run all the way to $500?
Well, to answer that, we are looking at a really comprehensive financial analysis report titled The Microsoft $400 Breakout, AI Profitability and Market Rally Analysis. It's dated February 8th, 2026, so this is hot off the press, analyzing data right as the market closed on the 6th. And the verdict in this report is pretty definitive.
Don't keep us in suspense. What's the verdict?
It suggests this is the real deal. This isn't a fake out. We are seeing a new leg up for the stock, driven by a very rare convergence.
A convergence of what?
You have a technical breakout, the charts look good, colliding with a massive fundamental catalyst, which is their record-breaking earnings.
So the charts and the actual business performance are finally agreeing with each other.
They are. And the report identifies a major narrative shift here. For the last year or two, the story has been AI expense. How much is this costing us? Now, the story is shifting to AI profitability.
I like the sound of that. Moving from how much does it cost to look how much money we're making.
Exactly.
But before we get to the money making, let's talk about the stock movement itself. You mentioned a technical breakout. What actually happened on the trading floor to make this significant?
It was forceful. You know, the stock had been consolidating, just kind of bouncing around sideways in the 390s. And then, bam, a surge of $7.47 in a single session.
$7 on a stock that size is no joke. That takes a lot of buying power.
It does. And the report calls the $400 level a psychological fortress.
A fortress. That
Right.
sounds dramatic. Why does a round number like 400 matter so much? Is it just that humans like zeros?
It is partly that humans like zeros, but you have to understand the mechanics of why 400 matters in modern trading. It is about where the limit orders are sitting.
You mean people setting automatic instructions to sell?
Think of it like a dam. There are thousands of investors and traders who bought the stock lower, and they told their brokers, if it hits $400, sell it and take my profit.
Right.
So you have this massive wall of sell order supply sitting right at that price. For weeks, every time the price touched $399, it got slapped back down because there were more sellers than buyers at that specific cent.
It's a ceiling. A concrete ceiling made of sell orders.
But, and this is the key from the report, what happens once you punch through that ceiling?
The sellers are gone.
The sellers are gone, the dam breaks, and then the buyers sitting on the sidelines, specifically the algorithmic trading bots, wake up. The report details institutional algorithmic buying.
The robots.
The robots. These systems are programmed with simple logic. If price is greater than $400, then buy.
So it's a trigger event.
It's a floodgate.
Yeah.
The moment that close happened at 401.1 cents, managing millions of lines of code at hedge funds executed buy orders simultaneously.
Wow.
That's why the report argues this isn't a drift. It's a breakout. It becomes a self-fulfilling prophecy because the momentum algorithms kick in to chase the trend.
So breaking 400 didn't just look cool. It literally flipped a switch in the market machinery.
And now the floor has moved up. The report points out that the intraday low of $392.92, $392.92 is the new support level. As long as we stay above that, the technicals say we have shifted from a correction phase into a confirmed uptrend. The stock is trading above its 20-day and 50-day moving averages.
Okay, so the technicals are flashing green. The robots are buying. But I'm a fundamental guy at heart. I want to know why the humans are buying. You mentioned earnings earlier as the fuel.
This is where it gets interesting. This isn't speculation. This isn't people betting on a future promise. This is grounded in the fiscal Q2 2026 earnings that just dropped.
Let's hit those numbers. Because when I saw the revenue, I did a double take.
It is staggering. Revenue hit $81.3 billion. That is up 17% year over year.
17%. For a company that was already worth nearly $3 trillion.
We have to pause on that because of something called the law of large numbers.
Which usually means...
Yeah, and giants move slow, right?
Usually, yes.
Yeah.
The bigger a company gets, the harder it is to grow at double-digit rates.
Yeah.
To grow 17% when you're a startup is easy. You just find a few new customers.
To grow 17% when you're Microsoft requires finding billions of dollars in new revenue. It's like trying to turn a cruise ship like a jet ski.
And yet the cruise ship just did a drift turn.
Microsoft is defying that law. Growing a company of this size at 17% is incredibly rare. But the revenue is just the top line. The profit explosion is where the real story is.
Go on.
Net income was up 60%.
60. 60. Okay, hold on. That sounds too good to be true. How do you jump profits by 60% in a year?
You are right to be skeptical. I have to add a crucial nuance here because the report is very careful to point this out.
Okay, lay it on me. Where's the catch?
That 60% number includes some investment gains, specifically from their stake in OpenAI. So some of that is paper game.
Yeah.
The value of their investment went up, so they book it as income even if they didn't sell anything.
So it's accounting magic.
Well, it's valid accounting, but it distorts the picture of the actual business operations. But, and this is the big but, even if you strip that away, their core operating income still grew by a massive 21%.
So even without the OpenAI investment valuation, the actual business of selling software and cloud services grew profits by 21%.
Yes, and think about what that means. Everyone knows Microsoft is spending billions on AI chips and data centers, right?
Oh yeah, buying all the GPUs they can find.
And yet their operating income grew faster than their revenue. That means their margins are expanding. They are becoming more efficient, even while spending historic amounts of money on infrastructure.
That is the AI profitability shift you mentioned in the intro. They aren't just burning cash, they're printing it.
Leading the charge is the cloud. Azure is growing faster than Amazon's AWS. Microsoft is solidifying itself as the leader in enterprise AI. If you are a big company and you want AI, you are increasingly going to Azure.
Okay, so business is booming. But here is the part that melted my brain a little bit when I read the report. It claims that the stock is actually cheaper now at $401 than it was when it was trading at $350.
It sounds like a paradox, doesn't it? How can it be cheaper if it costs $50 more?
Exactly. Make it make sense. Is this just analyst speak to get me to buy?
It comes down to the PE ratio, price to earnings. It's the standard way we measure if a stock is expensive.
Right.
You take the stock price, the numerator, and divide it by how much money the company earns per share, the denominator.
Right. Basic math.
So the price went up a little bit.
But the earnings went up a lot.
A massive amount. So mathematically, the ratio collapses. The report pins the current forward PE at roughly 25.1x.
Okay.
Now, to the uninitiated, 25 times earnings might still sound expensive compared to a bank or an oil company.
Yeah, but we aren't comparing them to Exxon.
You have to compare Microsoft to Microsoft, and this is where the sale sign lights up. Microsoft's 5-year average PE is roughly 33x.
Oh, wow. So historically, people have been willing to pay 33 times earnings for this stock.
Investors are usually willing to pay a premium for this kind of safety and growth, but right now you can buy it for roughly 25 times earnings.
So typically you pay $33 for every dollar of profit. Right now, you're only paying $25.
You are getting the same company, the same dominance, but at a roughly 25% discount to its historical valuation. And the report uses a concept called mean reversion to suggest what happens next.
Which is the market's tendency to go back to normal.
If the stock price just drifted up enough to hit that normal 30x or 33x multiple without the company earning a single extra penny, the stake price would have to sit at $480.
So you wouldn't even need the earnings to grow more. You just need the valuation to normalize.
Yeah.
That is wild. And I saw something about a PEG ratio too.
The PEG ratio compares the price earnings to the growth rate. It's a favorite of growth investors. Usually anything under 1.5 is considered very attractive for a growth stock.
And Microsoft.
Microsoft is under 1.5, with earnings growth over 20%.
So you're getting high growth at a discount price.
That's the argument. And that is why the report cites an analyst target of $596.
96.
That's the implied upside, about 48% from where we are sitting right now.
Okay, that is a very bullish case. Let's play devil's advocate for a second. There are other players in this game. You've got the Magnificent Seven. Why Microsoft? Why not Google or Amazon? The report talks about this magnificent gap.
This is key. You can't just look at Microsoft in a vacuum. You have to compare them. The report outlines specific advantages over the big three: Google, Apple, and Amazon.
Let's go through them. Google first. They are the AI pioneers, aren't they?
They are, but they are suffering from the first mover disadvantage, or the innovator's dilemma. Microsoft has successfully monetized AI with Copilot faster than Google has integrated Gemini or Bard.
Why is that?
Because Google's core business is search ads. If their AI gives you the answer directly, you don't click the links. You don't see the ads. They are hesitating because AI threatens their golden goose. Microsoft doesn't have that problem. They are selling Copilot as a subscription. They are selling the product. Google is still figuring out how to fit it in without breaking their business model.
Right. Microsoft is charging monthly subscriptions for Copilot right now.
Yeah.
Revenue versus experiments. Okay, what about Apple?
Apple is struggling with hardware saturation. The report points out that iPhone growth is slow. It's hard to sell a new phone to everyone every year.
Whereas Microsoft sells software.
Software-centric, recurring, high-margin revenue. It's much more stable. But the biggest jaw-dropper for me was the comparison with Amazon.
Oh, the margin comparison.
Yeah.
I highlighted this too because the numbers seemed impossible.
It is staggering. The margin comparison is frankly violent. The report highlights that Microsoft is running at a 47% operating margin.
Which is absurd for a company that size. That means for every dollar of software they sell, they keep 47 cents as profit before taxes.
It's essentially a software money printer. Now look at Amazon. Amazon is a logistics beast. Warehouses, trucks, boxes, thousands of employees packing things.
Yeah.
Their operating margin is hovering around 11%.
11 versus 47, that is a massive difference in efficiency.
It's a difference in business physics.
Yeah.
And the report argues this is why the Magnificent Seven aren't all created equal. In a high interest rate environment, or if the economy gets shaky, who would you rather own?
Right.
The company that needs to spend 89 cents to make a dollar, or the company that only spends 53 cents?
One with the cushion. Microsoft can afford to be wrong. They can afford to waste $1 billion on a failed experiment.
Amazon has to be perfect. Microsoft just has to be present. That 47% margin gives them a magnificent gap of safety that the other tech giants, even Google, are struggling to match right now.
It really highlights how different these tech giants actually are. We lump them together, but the engines under the hood are completely different.
Completely different.
Okay, we have been very positive so far.
Right.
The technicals are good, earnings are great, valuation is surprisingly low compared to history. But my job is to worry. What could derail this train? The report has a bear case section. What's in there?
You have to look at the risks. And the biggest one is what we call CapEx shock.
Capital expenditures, spending money.
Massive amounts of money. Microsoft is spending nearly $4 to $5 billion per month on data centers.
Per month. That's the GDP of a small country.
It is. And right now, that's fine because revenue is growing fast. But here's the risk. These are fixed costs. Once you build the data center, you have to pay to run it and cool it.
It's operating leverage.
Precisely. If revenue slows down even a tiny bit, if the economy hiccups, that massive fixed cost will instantly crush those beautiful profit margins we just talked about. It cuts both ways.
So they're walking a tightrope, a very profitable tightrope. But if the wind blows, it could get ugly fast.
It creates a high leverage situation. They are betting the farm on this AI demand continuing forever. And then, of course, there is the regulatory headwind.
The government.
The report specifically mentions continued scrutiny regarding the OpenAI partnership. Is it a monopoly? Is it an unfair advantage? And the EU is always watching the cloud space closely. Headlines about antitrust lawsuits can spook investors very quickly.
That's true. Nothing kills a rally like a subpoena.
And we can't ignore the broader market. If the S&P 500 dumps, Microsoft will go down with it no matter how good their earnings are.
So we have the bull case and the bear case. Let's bring it home. The report wraps up with a conclusion called "The Sleeper Wakes Up." What's the final strategy here?
The narrative summary is that the stock has digested its gains from last year. It took a nap, reset its valuation, and has now woken up to prove AI is real cash.
And for the listener who is looking at their portfolio right now, what does the report say to do?
It gives two clear paths. If you are bullish, you want to watch for a retest of $400.
You want it to bounce off 400, not fall through it.
You want to see that ceiling turn into a floor. If 400 holds this support, the technical path to 425 and then 450 is open.
And if you're cautious, what if this is a trap?
The report gives a very specific number for a stop loss, $392.
Why $392 specific?
That was the breakout level and the recent low. If the stock closes below $392, it means the breakout failed. The institutional buying we talked about has dried up.
The thesis is dead.
At that point, the thesis is invalid and you get out.
Okay, so $392 is the danger zone.
But the final call from the analysis is to buy or accumulate on dips. They are eyeing the 500 club in 2026.
The 500 club.
Yeah.
It sounded impossible a year ago, but here we are.
The math supports it.
You know, this whole deep dive has got me thinking. The report mentioned that we are moving from AI expense to AI profitability. And Microsoft is the poster child for that.
It is.
But it leaves me with a burning question for everyone listening to Mull Over. If Microsoft is the first to prove that AI can generate massive, scalable profit, what happens to the companies that are still just spending billions on AI without the revenue to show for it? That is the crucial distinction. Are we about to see a massive divide in the tech market? The AI haves who make money and the AI have-nots who just burn it. Because if this report is right, the market is starting to demand receipts. It's not enough to say we have AI anymore. You have to show the money.
The patience for hype is running out. Performance is everything now.
It certainly seems that way. And Microsoft seems to be the first one to cross that finish line.
Or the starting line of a new race.
The starting line. I like that. Well, we will be watching that chart closely. Keep your eye on that $392 level, folks.
Don't forget to like, share, and subscribe for more.